Okay, let's take a quick little look now at Spotify, not Shopify. You know, they're close in name, but different in purpose. It was my chair that made that noise. Don't you worry. Even if it came up on the audio, I don't know. But the stock was down pretty big this morning. It leveled out. Now it's around 2% down. So let's take a look at these earnings and see what the reasoning for it. Again, it's a good environment for Shopify. Oh gosh, he's already doing it. It's a good environment for Spotify. Really because more people have a lot more free time and they can spend a lot more time on the application. So I want to see what that translates to. Quarter 2 EPS of negative €1.91. Is that a thing? 1.91 may not be comparable to 36 pence. 36 cents of euros. I don't remember. Why can't I think of the currency? I can't. Revenue of 1.89 billion euros, up 13% year over year. They did miss by 40 million euros, but it's definitely good growth year over year. I kind of wanted better numbers, right? I wanted a beat in terms of revenue. EPS is ugly, by the way. But again, I think there was a charge in there, and I think that's why it's not comparable. But I should mention that. So gross margin 25.4 versus 24.6 consensus and above the guidance. So total monthly active users was 299 million versus 298.3 million consensus and guidance of 289 to 299 million. So they did, I guess, beat overall in terms of monthly active users, which is big. I expected more on that too. I really did. Revenue of 1.8 billion, 1.89 billion euros, shy of estimates. Quarter 3 guidance is light, which is why the stock's down, with revenue of 1.85 to 2.05 billion euros versus consensus of 2.01. It's not that light, but overall it's on the lighter side. Total monthly active users expected to be 312 million to 317 versus 299 in Quarter 2. It is a good rise overall in terms of monthly active users for sure, so we do like to see that. Quarter 4 revenue guidance of 2.05 to 2.25 versus a consensus of 2.18, so a little light there as well. And monthly active users of 328 to 348. So definitely notable. There was some softness early in Quarter 2, including lower intake, increased churn, and increase in payment failures from premium users. Do people not afford Spotify Premium? It's $10, right? Isn't it $10? I think it is. But how can you not afford that? Things rebounded strongly in June. However, we believe the improvement momentum we saw back half of the quarter has continued into Quarter 3. I mean, they try to give good words, but the guidance doesn't back it up. So if we look at their press release, total monthly active users saw a 29% year-over-year growth, which is big. Only 5% quarter-over-quarter, but 29% year-over-year is good. Premium subscribers rose 27%, and ad-supported monthly active users, or the free plan, I don't know why I said it like that, rose 31%. You want to see more premium, obviously, than just your basic. Your ad-supported. It's more beneficial for the company, obviously. Premium makes them more money. So, from financials, as far as dollar amounts, you see a big rise in millions of euros. So 1.7 billion that was gained from premium users, and ad-supported only 131 million. So that's where you see the difference there. Gross profit was up 10%. But operating loss of 167 million is not beautiful. Free cash flow saw a big decline too, year over year. So not beautiful. Premium subscribers obviously pretty massive there as they talk about that, but there's really uncertainty as far as how that will continue. That is one major thing here. I did want to get into operating loss here. So operating expenses totaled 646 million. euros, which increased 48%. Core operating expenses grew slightly. So there were also social charges related to strong gains in stock price. Social charges of 126 million euros. Definitely part of it hurt their, made it a little bit non-comparable, as you see. So social charges are payroll taxes associated with employee salaries and benefits, including share-based compensation that we are subject to in various countries in which we operate. So again, that's part of what happened as far as their increase in expenses is concerned, but I mean it's only really about 1/6 of their increased expenses. So I still don't see how it's fair to say not comparable, but that's what they said. So we just gotta believe what they said. So as far as content's concerned, they announced a multi-year license agreement with Universal Music Group, which is the largest music company in the world. The company's really focused on music. They also are focused on podcasts, which is why they signed Joe Rogan, naturally. So there's a big deal as far as ebooks, podcasts, and I think that really is one of the very big benefits of the future for this company and where they can find benefit. Because, I mean, not to say music has its limits, but it limits your audience base if you're not getting into the ebook category, if you're not getting into the podcast category, because not everyone wants to listen to music, and they're not going to pay a premium membership if they don't listen to music that often, or if they don't want to stream it. Some people still go old-fashioned and they buy discs. I mean, don't ask me why that's a thing. Maybe for collectors, I get it, but otherwise, people who buy CDs, more like CDs nuts. That's all I can tell you. So, for me, I think that their main focus needs to be on really increasing their audience base by expanding the content on the platform. And they do that really through, ebooks. Again, like I said, we talk about audiobooks and podcasts. Big for them. Big for them. I would like to look at this balance sheet, which is obviously in millions of euros, so don't get confused here. These aren't dollary dues, okay? Assets, total current assets on this company right now, you see total assets of 5.5 billion euros. Don't get it twisted. What kind of a comparison is this? It's a 6-month comparison. So total assets 5.5 billion euros versus 5.1 billion. Total liabilities in general of 3.4 billion versus 3.085 billion of 6 months ago. So definitely something that I think you could technically get concerned with, because really they only balance out by, $2 billion over in terms of assets compared to, or 2 billion euros over in terms of assets compared to liabilities. Can be a concern, especially when you see a massive operating loss like this quarter, but I think the company will be fine. I think the question of profitability comes into place when you're talking about the stock valuation. And obviously you can't even give it a fair PE ratio right now because, well, it's not possible. The stock is, not making money right now. So the company's not making money. You can't give it a proper valuation, but you can still trade it off this market cap if you want to. $48.68 billion market cap, when you can see overall annually they're likely only going to pull in, let's be fair and say $9 billion. So is $9 billion fair to justify a market cap of $48.68 billion when we talk about slowed user growth and slowed revenue growth? I think it depends. It depends on your vision on this company. I've seen a lot more highly valued companies for sure. And the valuation on this thing has definitely it's gotten steep. I can't lie to you. I think it's this past since April has gotten a little too steep. I think this thing's a lot more valuable under $200 than where it's at right now. Again, that may be ridiculous to ask, but I would not consider buying this thing unless it's under $200 right now. That's just me. But I could be wrong on that aspect, so whatever you view this as is fine with me. I just don't view it as valuable at this current level. So I really hope you enjoyed.